This is the week of August 7th to 13th, 2026. 5 days in which the market was told inflation was cooling, then told the opposite, and finished not knowing which to believe. Every number in this briefing comes from a published source, and every source is named on screen when the number appears. If a figure could not be traced to a report, it is not in this video. Here is what actually moved. Brent crude settled around 5% higher at $87.72 a barrel, and West Texas Intermediate climbed about 5% to close at $82.13. The move came as prospects faded for an imminent United States and Iran agreement over the Strait of Hormuz. Iran's foreign ministry said Washington must lift its blockade before Tehran would agree to fully open the strait. The Strait of Hormuz is the narrowest point in the global oil trade. Traffic through it has been severely disrupted for most of the past 5 months by attacks on shipping and retaliatory strikes. When a waterway that narrow is in question, the price of crude stops being about supply and demand and starts being about risk, and crude feeds straight into petrol, freight, plastics, and food, which is the same producer price pipeline that ran hot this week. Brent crude ended the previous week down more than 7% on signals from Washington that an agreement with Tehran was in sight. No agreement materialized. President Trump had called off a planned strike on August 1st to allow negotiations to continue, and has said many times that a deal is close. Positions on both sides then hardened. This is a pattern worth naming because it repeats. A statement that a deal is near moves the oil price immediately, and the absence of a deal moves it back. Nothing physical changed in the strait between those two moves. If your money is exposed to energy prices, you are exposed to the gap between what is announced and what is signed, and that gap has now cost roughly 7% in one direction and 5% in the other inside a fortnight. Core consumer prices rose 2.5% over the year to July. That is the slowest annual pace since March 2021. Headline CPI rose just 0.1% on the month, pulling the annual rate down to 3.4% from 3.5%. Core is the number the Federal Reserve actually watches because it strips out food and energy, the two things that swing hardest for reasons that have nothing to do with policy. 2.5 is close enough to the 2% target that the argument for another hike gets much harder to make. Worth keeping in proportion, though. Cooling means prices are rising more slowly, not falling. The cost of living does not go back to where it was, it simply stops climbing as fast. The S&P 500 reached a fresh record high after its best 5-day run since April. The trigger was not a strong economy. It was a shockingly weak July jobs report. This is the market's strangest reflex, and it is worth understanding. Weak employment means the Federal Reserve is less likely to raise rates, and cheaper money lifts share prices. So bad news for workers became good news for portfolios. Those two things are not the same economy. The 10-year Treasury yield fell to 4.64%, down sharply from the 4.74% high of the previous week. The 10-year is the reference rate for the whole economy. Mortgages, car loans, and corporate borrowing are all priced off it. A 10 basis point move in a week is not noise. It is the bond market changing its mind about how long rates stay high, and the direction matters more than the level here. Yields falling means bond prices rising, which means investors were buying government debt harder than the week before. The 10-year note auction cleared at the highest yield for that maturity since 2007. Dealers went into the week expecting the 30-year bond sale to price at the highest financing rate in roughly a quarter century. An auction is where the government finds out what its debt actually costs. Clearing at a 2007 yield means buyers demanded pre-financial crisis compensation to lend to the United States for a decade. That cost lands in the federal budget for the next 10 years. Interest on the national debt is now one of the fastest growing lines in the federal budget, and auctions like this one are exactly where that cost gets locked in. Producer prices rose 3.3% over the year in July, up from 2.4% in June, and far above the 2.5% that had been forecast. Producer prices are what businesses pay before anything reaches a shelf. When that number jumps by nearly a full percentage point in a month, the cooling story consumers just heard on Wednesday looks a lot less settled by Thursday. Traders immediately scaled back their bets on a September cut. There is normally a lag of a few months before producer costs show up in what shoppers pay. So a hot producer number in July is a statement about autumn, not about this week's receipt. Futures markets moved to price roughly a 56% probability that the Federal Reserve holds rates steady at its September 16th meeting. 56% is barely a coin flip. That is the honest state of it. The market is not confident about what happens next, and anyone telling you they know what the Fed does in September is reading the same 56% you are. It is also worth saying what a hold actually means for you. It means the rate on a new mortgage, a card balance, and a car loan stays roughly where it is for at least another 6 weeks. A pause is not relief. It is the absence of further pressure. Retail sales grew 0.5% on the month in July. That matched forecasts, but it was slower than June's upwardly revised 0.9%. Consumer spending is about 2/3 of the American economy. Growth that halves from one month to the next, while still positive, is the shape of a slowdown rather than a stop. It is the sort of number that looks fine in isolation and different in a trend. A single, shockingly weak July jobs report flipped the Federal Reserve narrative from a possible hike to a probable pause and set the tone for the entire week that followed. One data point moved the expected path of interest rates for an entire economy. That tells you how thin the evidence is that policy is being steered by. It also tells you why a single revision next month can undo the whole story. Employment data is also among the most heavily revised of any government series. The figure that moved the market this week may not be the figure that survives the next release. Information technology, consumer discretionary materials, and communication services outperformed on the week. Utilities, energy, and real estate lagged. That split is a rate story in disguise. Utilities and real estate are the sectors people buy for income, and they compete directly with bonds. When yields are high, those sectors struggle. When investors expect rates to fall, growth and technology lead. The sector table is telling you what the bond market already said. If you hold a broad index fund, you owned every one of those sectors this week, the winners and the laggards together. That is the whole point of an index, and it is why a single sector's bad week is not a reason to do anything. The hotter producer price data released on Thursday led traders to scale back expectations of a September rate cut, and that weighed directly on gold's outlook. Gold pays no interest. Its main competitor is a government bond that does. Every time the market decides rates will stay higher for longer, holding gold costs more in foregone yield, and the price feels it. This is why gold reacts to inflation data it has no direct connection to. Thursday brought results from Brookfield, NetEase, JD.com, Tapestry, Applied Materials, and New Holdings. Applied Materials reported third quarter fiscal 2026 results after the close. Applied Materials makes the equipment that makes the chips. It sits one layer beneath the artificial intelligence companies everyone actually talks about, which makes it a cleaner read on whether the spending is real. Equipment orders are booked long before the revenue anyone celebrates. So what does the week add up to? Oil swung 5% on a deal that has still not been signed, and the Strait of Hormuz remains the single largest unpriced risk sitting over every other number in this briefing. Consumer inflation cooled to its slowest core reading in more than 5 years, and producer inflation ran hotter than anyone forecast in the same 7 days. Both are true. They are measuring different points in the same supply chain. And they disagree about where prices are heading next. That is why the odds of a September hold sit near a coin flip rather than a consensus. The honest summary is that nobody watching this market currently knows what the Federal Reserve does next, and the people who sound most certain are working from the same 56% as everyone else. This briefing was built entirely from reporting and data published this week by the outlets on screen. Every figure is dated and verifiable.